Making your dream a reality. How many of you own a home right now or have a mortgage? None of the students do. Okay, good. All right. Well, I was a little bit different from John and a little bit different from you guys. I started out as a teller at a credit union at 18 years of age, right out of high school. And I knew that I wanted to be a homeowner. I had visions of not investing in investments or 401k, but investing in real estate. And I didn't know I was going to be doing mortgages. I actually started out as a realtor and buying houses. But I bought my first house when I was 18 years old, $35,000 house. And started my home ownership journey there. Through the process, I now have several of those $35,000 houses and a few other ones here and there. Can you hear me now? Okay, sorry. So that was a little bit different. So you guys right now are you, how many are you renting? Okay, all right. How many of you want to own a home, or how many? Okay, good. All right, so we're going to, before we start going over the renting versus owning, I want to go over the actual mortgage process with you, because I know just thinking about it, you've never been through that process. You're just a lot of times you just turn off and go strictly to, I'll just continue renting because I don't think I can get a mortgage. I don't have the down payment, or I don't know the process. So we'll start off with kind of going through that process with you, what you can expect when you're getting a mortgage. So there's 5 steps to home ownership. The first one we have preparing for home ownership. And basically that is you guys thinking through your process, going through your budget to see what your life goals are and where you're at on wanting to get a mortgage. And then step 2, you need to understand the mortgages. Know what type of mortgages are out there, what it involves with getting a mortgage. And then step 3 is actually getting that mortgage, going through the process of working with the loan officer and getting that mortgage. And then step 4, making an offer, working with a realtor or working with the owner and getting a contract to purchase that home. And then step 5, we're going to learn about closing, what the closing process is. So we'll start with step 1, preparing for home ownership. Talked with John earlier about setting a budget. Biggest thing here is the same thing. You want to go through, find out what your needs, what your wants are, what your expenses are, what you have to pay. And he touched briefly on the mortgage, $1,000 and $700 a month we've seen earlier. But you want to make sure that what you budget for includes some of your expenses, what we call PITI. Principal, interest, taxes, and insurance. And so basically when you have a mortgage, you're going to be paying the principal, which is what you were loaned. You're going to be paying interest. Of course, we've got to make our money, so we're going to pay us some interest. And then you're also going to have your insurance, which is for your homeowner's coverage. So if something happens, we have those floods, we have a hurricane, or you have a fire, something happens, then you're going to be covered with homeowner's insurance. And then fourth, you're going to have the taxes. And then the taxes are what you have to pay to the government or the county for your property taxes for home ownership. So once you figured out what you can afford and where you're at in your budget, then we'll know how much cash you'll need to close. And this is including to prevent mortgage insurance premium, which we call PMI, private mortgage insurance. So basically, typically 20% down is what you're looking for on a home. When you want to buy a house, you're looking at 20% down. This is ideal, and this is what we recommend. However, you can certainly get 100% financing, and there are some lenders, like John mentioned earlier, that will include 100% plus your closing costs. So you can really get into a home with no money out of pocket. But ideally 20% down. It's going to save you the most money. You're not going to have the private mortgage insurance, which covers just the lender. It's basically saying that we're lending over 80% loan to value, and we have an insurance provider that is covering us as the lender in case you default. But yet you still owe us that money. So you don't want to pay that if you don't have to. But it's very common. 90% of borrowers do pay some type of mortgage insurance premium. And you want to research your mortgage options. Like we said, there's a lot of options out there. What mortgage fits you? You want to find out what is your life goal. Are you planning on being here for 5 years? Are you planning on being here for 10 years? Are you planning on advancing with your career? And so those types of questions are that you'll need to answer, but to figure out what options there are. We have several different options on adjustable rate mortgages that are fixed for a 5, 7, or 10-year period. So you would want to see what your life goal is with your career. We also have a 30-year fix. If you know you're going to own this home for your entire life until it's paid off, then you definitely want to go with a 30-year fixed mortgage. So you want to go over your options and find out what type of mortgage is going to be best for you. And then know your credit score. Sometimes you know you paid your bills, but you may not have a lot of credit out there. You may have only had a student loan, or you may have had just one car, and you may have missed a payment here or there. So before you go into searching for a home and spending time, you want to make sure that you actually qualify. 620 is the bare minimum most of the time for a mortgage. There are some lenders that can go lower than that, but honestly, you would be better off paying rent until you can get your credit up, so you're not paying those high interest rates on a subprime loan if you're under 620. Most lenders, though, are looking for a first-time home buyer of around 680. This is because of the private mortgage insurance. A lot of those lenders will not be able to get insurance if you're below a 680. So if you're looking at putting the 20% down, then 620 is kind of your go-to point. But if you're not going to be able to put 20% down, then you want to look at a 680 or higher credit score. I will say that Pen Air has a great option for its members if you find that your credit score is not where it needs to be. To get a mortgage, we have a balanced program, and they will work with you for free if you're a member to get your credit score where you need to get it. It'll talk about how you need to utilize your credit, what you can pay off, and how long it may take you to get there. So then we want to get pre-qualified. Once you think you know what you're wanting and you've done some research and you know what your goal is, then you want to get pre-qualified before you start shopping. What happens is you get out there and you start looking at the house that you want, and it's a $200,000 home, and then we find out that you only qualify for $100,000. So now you're starting out the process disappointed, and then you're starting back over with square one. So you definitely want to get pre-qualified before you start the process. So we talked about the principal and interest, taxes, and insurance. Something else that you want to keep in mind here is that this is not always included in your mortgage payment. So you'll want to talk to your lender about this. This is an obligation. All four of these you have to pay. But they're not always included. So when you first start talking about a mortgage with your lender, you want to ask, is this included? This is an option that they may or may not cover. So if it's not included and they're talking to you about a $1,000 payment, you may still have that extra $300 that you're going to have to tack on there. This is a good point to keep in mind that there are other expenses that come up that you do have to pay for with a mortgage or having home ownership. Sometimes you'll have homeowners association dues. A lot of subdivisions, condos, townhouses, other subdivisions like that will have fees that you have to pay on an annual basis or a monthly basis. Typically they're rather cheap, $50 a month, sometimes just maybe $50 to $100 a year. Some of them, however, though, can be upwards of $2,000 to $3,000 a year. So you definitely want to keep in mind that is something else that needs to be included when you're talking about your mortgage payment, because that's something you'll want to include. All right, so once we got pre-qualified, we kind of know where we're going. We want to look at the options on the terms with your actual lender. So we know what you're looking for. We know that you want a 5 or 10-year loan period. You know what you're looking at, how long you want to keep this home. But you don't really know what a fixed rate, adjustable rate, or interest rate, what's going to fit best for you. So there's several different options that you have. First, with the fixed rate, you can do a 15-year, 10-year, 5-year, 20, 25, 30, all up to 50 years. Typically, 30 years is what most lenders look for, and that's what most lenders go with. And a fixed rate is your less risky loan. However, the interest rate may be slightly higher than an adjustable rate, but you're less risky. Your fixed rate for a 30-year period or whatever period you choose on your home, so you're not going to have to worry about your payment fluctuating. However, if I decide that, hey, I'm moving in 5 years, or I know I'm going to be looking for a promotion within 5 to 10 years, I may go with an adjustable rate mortgage that's going to have a lower rate up front, but it can adjust in 3, 5, or 7 years, whatever option we choose. So my interest rate may be lower, my payment may be lower, but I know at year 5 and 7 it may go up, and it can go up. So it's a little bit riskier. However, based on what your life decisions are and what your goals are, we'll put you in a product with that. And then there are some interest-only loans out there. If you know that you're very temporary, you want home ownership, but you're not really worried about paying the principal down right now, you're just wanting to put some money towards a house and not towards land, to a landlord, then an interest-only loan is maybe an option for you. There's not a lot of lenders that offer it, but it is out there for you. And basically, you're just paying the interest on it until a certain time period, typically 5 to 10 years. And then after that, you either have to pay the loan off, refinance it, or they'll adjust your payments and start adding principal and interest. All right, so types of mortgages that we offer. We were talking about, there are some lenders that can do up to 100%. And a lot of that depends on the loan. You'll hear conventional, construction, USDA, VA, and FHA are your most typical loan types that you'll hear. For a first-time home buyer, FHA is typically the most common. It's funded by the Federal Housing Administration, and they will go up to 97% loan-to-value for you. So you only have a 3% down payment. And then a lot of times their closing costs can be included. They can give you some credits with their rates. They have very good rates for you that are typically lower than a conventional loan. So they can pay some of your closing costs by charging a little bit higher rate. So it's geared towards a first-time home buyer who doesn't have a lot of cash at hand. Then you have a VA. If you have some veteran benefits, then you certainly can qualify for that. Those are just basically funded by the Veterans Association, and they'll go up to 100% as well. Then you have USDA for rural development. It's funded by the Rural Development Housing Association, and they do more rural areas. The house has to qualify where it's located at. You have to qualify for income. But as a first-time home buyer, first time in the career field, then you may qualify to meet those limits. It's actually $74,000 is the household limit in our area here. It changes through the area, so it could vary wherever you decide to go work at or live at, but right now it's about $74,000 for the income levels for the 100% USDA. And then we have conventional loan. Conventional is more typical for if you've got some down payment. If you're looking at 5, 10, or 20% down, then a conventional loan is what you're going to want to go with. You can get less costs associated with that loan, and your interest rates are fairly reasonable with those as well. So once you've decided where you're going with and what you're getting on your mortgage, you start the application process. And this is where you want to really work with your lender to try to get the process going. You don't want to start this process after you found a home. After the market crash in 2007, 2009, the mortgage process can be quite lengthy. We're looking at a 30 to 45-day process to go through to get a mortgage. And so you definitely want to start up front with an application, and we're going to look at your credit score. We're going to be looking at, not only just what your score is, but how you've utilized your credit. What are your debts out there? Then we're going to be looking at down payment and other assets. So you may not have the down payment like we spoke earlier. You may be looking for the higher loan-to-value level. So there are programs out there. I did my first loan with the Federal Home Loan Bank of Atlanta. I paid $1,000 and they paid $2,000. There's programs here in the county that'll pay up to $15,000 for your closing costs and free gift money. You may have to keep your home for at least 5 years or sometimes up to 15 years. But there are some programs out there. So just because you don't have the down payment or the assets, this is a good point when you're working with the lender that they will talk to you about some of these programs that may be available for you. Air, we have a program that we're starting that will be for college graduates specifically. We have a mortgage insurance company that is willing to write a policy on us if you do not have a 2-year employment history and you don't have down payment funds. Those funds can be borrowed. A lot of times the lender will not let those funds be borrowed. So there are options out there. Employment history, like I just said, typically 2 years is what we're looking for. You want 2 years in the same job or in the same field. However, there are some lenders and there are some programs that will waive that if you're a college graduate. So it depends on the program that you're going with. But this is where you want to find out up front during the application process what you qualify for and where you're at and for a job. And then your income. We're going to take your gross income. That's what we're looking at, and this is, this is kind of where your budget comes back in. We're going to go through a budget process with you at application. We're going to ask you the questions. We're not going to look at just what's on your credit report. We're going to ask you, what are you paying for? Because it's important to make sure you've got a payment that you're comfortable with and that we're comfortable with, not just because we'll lend you that money, but we want to make sure as a lender that we're putting you in the right product. And so we're going to look at your income, your expenses, and we're going to make sure that this is something we both agree that you can afford, not just, hey, here's what you qualify for, but make sure it's something you're comfortable with, because this is the biggest commitment that you'll make in a mortgage, or the biggest financial decision you'll make is a mortgage. So once you've gotten through the application process, and now you are looking at making an offer on the home. So this is where a realtor comes in handy. You don't have to have a realtor. The seller pays for a realtor typically. However, a realtor is recommended because we do, as lenders, we know what contracts look like and we know what house values may be. However, we're not experts on the market. So a realtor comes in handy. Now, you don't have to have one. You can use a for sale by owner, and you don't have to pay any fees or anything like that for a realtor, and you certainly don't have to, but I definitely recommend you getting one, because the first thing we're going to talk about is the purchase price. When you're making a purchase price, when you're making an offer, most of us aren't experts on knowing what the market is worth. We may have an idea what we feel this home is worth, but this is where a realtor can pull some comps. What you'll hear from the real estate world is a comp, and basically what we're talking about is comparable homes that have sold that are like your home that you're looking at. And so they'll pull some comps, see what this home is worth to help you make an offer on this. They may be asking $200,000 and the comps may come back at $190,000, so they may recommend you offering $190,000. In this purchase price is also a good place to help make up for some of those funds you may not have for closing. It's very common, especially in our market here, that the seller will pay up to 3% of your closing costs. So in your purchase contract offer, you may put that in there, that, hey, I need some extra funds for closing costs towards me. You may also see that, it doesn't have the appliances or the updates that I want. So I want to add in some contingencies for that, where they can pay you some money at closing for some upgrades that you want. So this is where you want to really focus in on making sure that you're getting the best that you can, best price that you can, and getting the most that you can out of the seller. No one goes to a car lot and pays full price. You always negotiate. So this is definitely where you want to negotiate that. And then closing date. This is where you want to make sure that in the contract you have a clear defined time frame of how long they have to accept the offer, and then also how long you have to close on the loan. This is going to come into play with what type of loan you're getting. Some loans require a little bit longer process than others. So you definitely want to make sure that you're negotiating that in your contract. And you want to talk about the closing date when they're moving out. Sometimes they'll move out the day of closing, but you want to give yourself some time. Maybe you want to have them move out the day before closing so you can go look at and inspect the house, make sure nothing has changed since the last time you've been in there. So then you'll submit the offer. Typically, you'll give them 24 to 72 hours to come back with an acceptance or a counteroffer. And it's very common for them to counteroffer you because, of course, you want to start lower, and then they'll come back. One thing that a realtor will point out here is that this is someone else's investment. It's someone else's home. They put their blood, sweat, and their time and their hard-earned money in. So a lot of times, you'll see someone that comes in and just makes a very low-ball offer, and then they don't respond. That seller doesn't have to respond to you. They don't have to sell that house to you. And so this is where the realtor, again, will come in and help you make a reasonable offer, a fair market value offer, so that you're not insulting that seller and just trying to get the best deal that you can. So then once you've gotten the offer, they've accepted or you negotiated, then we start moving into the pre-closing period, or what you'll hear as a processing period. Basically, this is where the lender and you are going to do your legwork with the realtor to make sure that this home is really what you think it is. You're going to have a home inspection done. You want to get a qualified independent contractor to inspect this home. Not all lenders require this, so it's definitely something that realtors recommend. It may even be in your contract contingency, but you definitely want to try to get the home inspected to make sure that it has the security that you want with the structure, the soundness of the home, and then also that there's no little stuff that you didn't see that you may find out, oh, I do want this updated, or I do want this fixed. Maybe the air conditioner isn't as efficient as it should be. So this is where a home inspector is going to come in and tell you that. Through this process, you're going to have to get a proof of homeowner's insurance. And you're going to have to find an insurer, an agent out there. The lender and the realtor can both help you with that. But you'll have to get the proof of insurance, and you'll want to make sure that you go through the process of making sure you have the right coverage for yourself. There's lots of different policies out there. Some cover contents, some do not. Some do not cover your full costs of your home. If something happens. I personally came home one day from work and had a 3-month-old baby and freshly out of college myself, and my house was burnt down. And I had nothing but the clothes on our backs. And luckily, I had a good agent that gave me the coverage that I needed because a lot of content coverages do not cover your full replacement costs. So I was able to go out and buy everything that I lost without anything coming out of my pocket. So this is a big important step in the process of home ownership. You want to make sure that you're getting the right coverage. And then we talked a little bit about the final walkthrough. Once everything's approved, you've gotten the home appraised, the home inspection's done, everything is okay, the lender's giving you their final commitment, you're ready to go to closing. You want to do that final walkthrough to make sure that everything is just how you want it before you sign the dotted line. Because if something happens and you don't go through this walkthrough and you go to closing, once you sign those papers, that owner has no responsibility to fix anything on the house. So now we're going to move into the closing section. Now we're ready to sign. And so there's a lot of documents that are going to be going around. This whole process, like I said, it's taking 30 or 45 days. So by this time, you're going to know a lot of the lingo. You're going to know a lot of what's going on. But you're signing a lot of documents. You're signing for a lot of money. The average home around here is $145,000 to $170,000. For a first-time home buyer, we're looking at about $130,000 to $145,000 in our area. So that's a lot of money that you're committing yourself to for basically most of the time a 30-year period. So you want to make sure that you know the documents that you're signing. A lot of times the lenders will provide these to you 3 days before closing. They have to provide you certain documents 3 days before closing, but you can ask for every document 3 days before closing to give yourself a chance to look at them, to go over them. You can sit down with an attorney, sit down with a third party. The HUD department has free counseling that you can go to look over these forms with as well. But basically, you're going to be signing a mortgage note, which is a promise to pay the lender, and basically states that if something happens, that you understand that you lose your home, that you could be liable for any deficiency balances there. And then you're going to have a closing disclosure. This is something that is new. We used to have a HUD statement or a truth in lending statement. The closing disclosure is something that the Consumer Protection Financial Bureau created after the housing crash in 2009. So this is a form that you have to get 3 days before closing, and it goes over every cost that's associated with your loan. You'll start off with what you're paying the lender, what you're paying the title company, what you're paying to the seller, and what's come out of your pocket or what is coming out of your checkbook at closing for those home inspections. Everything that you pay for on the loan should be listed on this closing disclosure. And it's important to really look over this form because it also shows you what you were disclosed from the lender up front. A lot of buyers got into some trouble and got some things done wrong to them during before the market crash. They would be quoted some cost up front, and then you're going through this whole process. You're seeing documents you've never seen, and when you go to the closing table, you had fees that you had didn't know anything about, or that were much more than what you anticipated. But here you are, you're ready to close on your house. So who's going to walk away? And typically, most people, it's just a few $100s here and there, so they sign it and move on, and they don't really understand the process. So this form is very important to you, because you want to make sure that you look over it. It'll show you that what has changed, what didn't change, if it did change, why it changed. So now we've gone through the mortgage process, and yes, it's a lot. But before I go into the renting versus owning, does anybody have any specific questions regarding the mortgage process itself, or a mortgage? Yes.
So would the mortgage process change dramatically if you wanted to build your own home?
Yes and no. The mortgage process itself is still about a 30 or 45 day process. And the biggest thing is finding a builder, finding where you want to build at, getting the plans, getting a contract with that builder set up. Now that takes some time. But you typically, what you would do to build a home is you'd come in, we'll go through the first phase of that. Let's talk about your budget. What is your plans? How much can you afford? And then we would give you a pre-approval letter, and then you go find that builder, and you work out the type of home that you want, the upgrades, where this is going to be at. Are you purchasing the land yourself, or are they purchasing it? They're building on it, whatnot. You go through that process with them, and then you get a contract. And then once you get that contract, it's the same as a regular purchase. About a 30 or 45 day process once you get the contract.
And so with the builder's fees and everything, would the bank cover 100% of that? Like, say if that was, do they usually do that?
Typically on a construction loan, you have to have a little bit more money out of pocket. It's about 10 to 20%. There's not a lot of programs that have that have 97 or 100% financing. Most of the time it's caps at 90. However, right now what we're finding, this is loan to value. So we're talking about what you're loaning versus what the house value is. Right now we're finding a new home is appraising for more than what you're actually having to put into it. And so right now, yes, we have a lot of people that are going into a construction home, say their construction price is $100,000, but their appraisal's coming in at $120,000, $130,000. So they're not having to put anything down out of their pocket, because the home, when it's being built, it's already worth more than what they had to pay for it. So, and that's kind of unique to our area right now. We're just in a growing environment. And of course, across the country, construction is increasing, and so we are seeing that value difference there across the country. But this is a little more unique to us here that we're seeing. Yes.
If there's two people with two different credit scores that vary dramatically, how does that affect being able to qualify for a mortgage?
It's going to depend on how dramatic. If one is not qualifying, if they're 620 or below, then that could affect it. And we may need to work with the program to get you to do some credit counseling. However, if one is just right there on the line, and then someone's got a real high credit score, let's say 800, and someone else has got 620, what we do is we combine those, and we take the average of those scores to determine where you qualify as far as amounts and interest rate.
Which is more popular for college grads, fixed or adjustment rates?
Well, before millennials, that it was typically a fixed. But millennials, we like to take a little more risk. I'm a millennial myself, so I like a adjustable rate mortgage, because I know I'm probably not going to be in this house, or I'm not going to keep this house for 5 years. So I want a lower interest rate right now, and I'll take the risk that I can't do something with that house later on down the road. So we are seeing a change. It was typically a 30-year fixed, but we're seeing a change to an adjustable rate now. For one, rates are so low with an adjustable rate right now, and two, most millennials have the idea that they're not going to be in that home for more than a 5 or 10 year period. Any other questions? Yes.
Does the pre-qualification process or period expire?
Yes, typically it goes with how long your credit is good for. 60 days is typical, and then also depending on your circumstances, if there was, pay stubs, we may need to update pay stubs or whatnot, and a pre-approval letter will actually tell you exactly what is needed from you and how long that period, how long those documents are good for. But typically 60 days.
Do they still have mortgages that penalize you for paying it off early?
They are out there. However, there's regulations around that now. There were no regulations before.
Can you repeat the question?
Oh, I'm sorry. She asked if there are any mortgages out there that still charge a prepayment penalty for paying them off early. And the answer is yes, they are out there. However, there's a lot more regulation around that now. So you're definitely going to know it. You will have to sign documents specifically stating that up front and at the end before you would have any type of prepayment penalty. The max is 3% now. There was no max before. There is a max of 3%. Most loans that you would qualify for, though, as a first-time home buyer, are not going to have a prepayment penalty.
I was going to ask, what is the point of the prepayment penalty?
So, if I'm doing a FHA loan that we talked about earlier that is doing 97%, but I am upping my interest rate to give you some credits to pay for closing costs. So I'm giving you a little bit of extra money now as a lender, but I'm going to recoup it over this 30-year period in your interest rate. Well, if you pay it off in 3 years, I didn't recoup that money, so I'm going to charge you a penalty. And it's also just how we invest our own money, and how we sell mortgages and how we as a lender are operating our business. We want to ensure that we're getting that income for the next 3 years or so. So, any other questions? Okay, so we'll move into renting versus owning. And this is, like we said earlier, this is a decision that you need to make. I made very early on in life that I didn't want to rent a house. I didn't want to, what I had in my mind, throw my money away. I did find out later on down the road that owning a house with a small child in college and working full time, that I had to go to my neighbor's or to my friend's house whenever my water pipe busted and I didn't have the money to fix it right then. Or if I YouTubed how to fix a water element, a heater on a heater in the wintertime when it was out, because I didn't have a landlord to do that. So this is a decision you've got to make sure it's right for you. Home ownership, you don't have someone to come in and help you fix that house. However, I do have the opportunity to get some money back out of that house 3 to 5 years down the road when I sell it. Or if I want to upgrade, I can rent that house out and let somebody else pay the payment for me. So it's a decision you've got to make. So you got to weigh the pros and cons. Renting is less responsibility on your upkeep, but you may have more cash flow. Like I said, you're not going to have those extra expenses if something comes up, but you may be willing to take on that risk. If you own, you do have some tax benefits, and like I said, you're going to increase your personal wealth. You may have some some equity in that home later on down the road, and then also you have that tax benefit, what you're paying for property taxes, homeowners insurance, if you have mortgage insurance, and if you pay interest on your mortgage, all those can be tax deductible. So whenever you're looking at John's sheet up there, we have $350 and sometimes $500 taken out of your income. This is a way to get some of that back from the government if you have a homeowner, if you have an ownership. So. And then look ahead to the future. You must ask yourself, what additional financial goals would I like to accomplish as I make payments on a home loan? So, we have what do you want to do? Do you want to, I chose early on that I wanted to invest in real estate versus invest in my 401k. I've since changed that. I now do both. but you got to decide what's important to you and how you want to balance that budget sheet for yourself. Do you want the opportunity to build equity and have more cash flow available now? So, very often we'll have someone come in for a pre-approval and they qualify. Everything, they've got the money for down payment, they're ready to go, but then they just think about it and I could rent for $700 versus the house I really want is $1,000. I want that extra $300 right now. I'm going to hold off on buying a house. That's a decision you've got to make. And then this just kind of goes over the flow, kind of a chart to show you what, kind of where your break-even point is. And this is just an analysis. It's not like it's for everyone, but it just kind of shows on the first column there you have your rent payment. In the second column you have your mortgage payment. So in year one, I'm going to be paying $800 a month if I was renting, and maybe $1,000 if I had the mortgage. And then you can see in year 2, 3, 4, 5, and 6 that your rent is going up, but your mortgage is staying the same. And that's because you've chose either an adjustable rate mortgage that is fixed for that time frame or a 30-year fixed mortgage. But rent, if some of you are renting, I don't know if you've had this happen, but each year whenever you sign a lease agreement, sometimes they'll go up. This is based on 10%. I have 7 rental properties and all mine go up 20% each year. So it just depends on what what your landlord does. I've also had tenants that have been there for 6, 7 years. So, but I also have a little bit lower than fair market rent. So that's just an option how I work mine out. So this is the average though. 10% is the average. And so you can see, then you also have your monthly difference listed there, and then your tax savings. You really don't start seeing your tax savings until year 3. And then you keep going down and you'll see where in year 6 is really when you start seeing the benefit of actually having a home ownership versus renting. So really the home ownership is more of a goal for down the road. It's not you're going to buy a house and then 2 years later you're going to have equity and you're going to be saving money. It's down the road. However, in this market right now, you may buy a house and then next year you have equity. They're rising house values are rising at 6% a year right now. So you may have some equity next year. But home ownership is really looking at the future. And so you can see where year 6 is where you really start seeing the break in the investment. So we've gone through the mortgage process. We kind of know the pros and cons. So you just kind of got to ask yourself, renting suits you if you have a possibility of moving in the next 5 years. You really don't want to try to buy a house if you know that you're going to move in the next 5 years. I mean, that's not saying don't buy a house. You certainly can, because like I just said, values are going up, so it may be in a good investment for you. But the costs that are associated with buying a house and getting a mortgage may not be beneficial if you plan on moving the next 5 years. If you have no cash for down payment, then certainly renting is going to be maybe your best option. However, like we said, there are those down payment assistance programs. Pretty much any lender out there has some type of program. Some have more than others. Some are better than others. But there are options out there. So don't think just because you don't have the money now doesn't mean you cannot get a mortgage. And then no time for upkeep. You may not want to be up at 10 o'clock at night fixing a water heater or trying to replace a heater element or whatnot. So you may enjoy having someone else take care of that for you. And then if you can't afford the extra fees, sometimes you have those homeowner association dues, or you're going to have, the breakdowns or whatnot. If you can't afford those extra items, then it may not be the right time for you. And then the fluctuating housing market, values are rising, but so are interest rates. So you may not want to get stuck in a house that you have right now that's on adjustable rate mortgage, and it may go up later on down the road. So you may not want to get in that situation, and values could certainly crash again, and then you're stuck in a house that you're upside down on. So it's a decision you've got to make to see if it's worth the risk to you or not. And then, of course, sometimes you may have the borrower that doesn't have the credit score where it needs to be. So it's just not an option right now. So renting is your best choice. So it's working with a lender or a credit agency to get your credit score up so that you can get to that point. The question is, what is the average interest rate right now? And my answer was around 4% on a 30-year fixed. So I'll have to get some more cards for you guys. Any other questions?
No. seems like a lot of this is, what you're able to do is going to be based on credit score. What could students that are about to graduate and they're taking their first position in the real world, what can they do to up that credit score? And then what are some things that they absolutely better not do, or it's going to mess that credit score up?
So don't go over your limit on your credit card. Like John said, use it as an emergency. If you're going to max it out, don't go over that limit. If you go over the limit, it's certainly going to affect your credit score. 10 to 15 points per month, it could drop your score. Now, of course, lowering it is going to rise it right back up, but it takes some time. Once your credit score has gone down, it takes a little bit of time to get it back up. Second, utilization. You don't want to go over a 35 to 50% utilization mark. Not only do you want to cap it, not max it out, but if you are going to carry a balance on a credit card, you want to try to leave it at 35 to 50% of your credit limit. And then length of credit. Sometimes you at least need 2 years of credit history. And so if you don't have 2 years of credit history, doesn't mean you can't get it, and it doesn't mean your credit score is going to be where it needs to be, but typically 2 years is what you're going to need to have a credit score high enough. And then also, you do not want to have a late payment. Make sure you make your payment on time. If you can't make it, call your lender. I worked in collections. They'd rather have you call them up front than after the fact. And so if you're trying to work on keeping your credit score high, but the money just isn't there and you're working on that budget, call them before you get to that point, because maybe there's something you can work out with them to prevent that. Yes, ma'am.
I have a question. Are there any fees for applying for a mortgage?
Are there fees applying for a mortgage?
Just to apply for one?
Yes and no. So there's certain fees that we can charge as a lender. Typically, there are no fees that you have to pay up front, but there are some lenders that require a $400 application fee or a $28 or $30 credit report fee. However, those fees are credited to you during the loan process. It's not just that they can't take it just for income. It has to be applied towards your mortgage if you go through. Yes, sir.
What impact do student loans have on the credit score?
As long as you're paying, I guess everybody here, the question is what impact do student loans have on your credit score? So a lot of times student loans, especially for you guys, are going to be deferred right now, so you haven't actually been paying on them. And they're going to be maxed out on their credits, on their utilization. However, they're not necessarily adversely affecting your credit as long as they're shown deferred. Now, if they are shown deferred payments, we still have to calculate what your payments would be for qualifying, but it doesn't adversely affect your credit score. Once you start making payments, you're still going to have a higher utilization there, but it's not going to adversely affect it because you're not going to be over the limit, and those are not a revolving, so you don't have to worry about how much you have out there. Just make sure you make the payments on time. As long as you make the payment on time, they're not going to affect you.